Hi students, welcome to the video on business mathematics and statistics. Topic is learn profit and loss account in 2 hours. So glimpse of the topics are mixture and allegations, then 6 types of price of article, that means rate at which an article is sold, tender or quoted. It may be that mixture and allegation, it may be expressed in rupees, biadly rupees 2 per mango, or in quantity, biadly 5 lemons per rupee. And the various types of price of articles may be mark price, sales price, invoice price, tender price, quotation price, and the mark price. So types of discount may be trade discount, cash discount, and bill discount. So we have to discuss some model questions from profit and loss account. So first you should know what is mixture and allegation. Mixture and allegation are mathematical concepts used to solve problems combining two or more ingredients to create a final mixture with a specific average value or concentration. A mixture is the combination of substances, while allegation the rule or method used to find the ratio in which these ingredients must be mixed. So this mixture and allegation method is commonly used in area like aptitude test, means it is very important for all competitive examination, that is aptitude test, to determine the proportion of different priced item needed to achieve a desired price for final mixture, or desired quantity to be mixed to get a targeted result. Here we will get one example. A retailer purchased some rice of two varieties, one 50 rupees, another variety 40 rupees per kg respectively. Respective means first variety is 50 rupees, second variety 40 rupees per kg. In what ratio should he mix them so that he can have a clear 20% profit by selling them at a 50 rupees per kg. When selling 50 rupees per kg, suppose there is profit of 20%. So we have to find the cost price first. So cost price here 20% profit on CP means when cost price 100, cost price CP 100, profit 20, SP is equal to 120. So SP is 120. So when SP 120, cost price is 100. When SP 1, cost price is 100 by 120. That is 5 by 6. When SP is 50 rupees, cost price of that mixture is equal to 5 by 6 into 50. That is 25. Then here 3. It may be 250 by 6, or we can write 250 by 6, that it is written here. So, a retailer purchased some article of two variety, 50 rupees per kg and 40 rupees per kg, and mix them and sell at 50 rupees per kg, earning a profit of 20%. So, average cost is 250 by 6. that we can represent here like this: variety, first variety, second variety, difference cost, first type is 50 rupees, second is 20 rupees. Average cost is 250 by 6. So first the difference in cost we have to find out. Second variety, that is second variety 40 and 250 by 6. But how much is the difference? In case of difference, the symbol is not the matter. So 40 minus 250 by 6 or 250 by 6 minus 40, it will give you 10 by 6. And first variety and average cost, 250 by 6 and 50. Difference is 50 by 6. So the ratio is proportionate difference 10 by 6 is to 50 by 6. That means the mixture ratio is 1:5. That means 1 kg from first variety. Suppose 50, that we can prove. 50 into 1 is 50. And 5 kg from second variety, that is 200. Then here it is 250 rupees, and he now it is 250 rupees. He is selling 50 rupees for kg, means suppose it is 1 kg, 5 kg, 6 kg, 50 into 6 is equal to 300 rupees. So profit is 50. So percentage profit is 50 by 250 into 100. So it is 20%. So our answer is valid. The profit here is 20% given in the question. So like this, by doing this type of mixture and alligation formula, first variety and second variety, here we will put the difference cost, then average cost, then we find here the difference in cost, then proportion of discount on difference on costs. Then we got the answer 1:5. Without solving the problem in shortcut, we will get it. This is very important for facing the aptitude test in any entrance examination. So we will solve so many problems like this by putting this type of formula. So another question we will solve from the problem or from the book, that is, here it is given, person purchased a tractor and carriage for 3 lakh. So cost price of tractor, it is given 3,60,000. He sold the tractor at a profit of 20%. Sales price is equal to 3,60,000. 20% profit, 120 by 100. That is 6, then 5. So sales price is 72,000 into 6, 4,32,000. This is the sales price. And the the cost of both tractor and carriage is 3. Now it is given the cost of tractor and cost of carriage. This question is given, one variety is cost of tractor plus cost of carriage. It comes to one tractor, one carriage. Cost of one tractor and cost of one carriage is given 3,60,000. Then he sold the tractor at a profit of 20%. Then carriage at a profit of 30%. And his total profit is, his total profit is 21, 2 by 3%, that is 45 by 3%. We put the formula like this. So we got first variety. Variety means first variety is tractor, second variety is your carriage, second variety. Then we will write the difference in percentage. Here percentage is there. So difference in percentage. First is given 20%, second is given at a profit of 30% sale. That means tractor is sold at a profit of 20% and carriage is sold at a profit of 30%. Then average, his total or average profit. Average profit is 45 by 3. So we have to do the like first difference between second and average. This you will write difference in percentage. Difference in percentage. That means 30 minus 45 by 3 or 90 minus 45, that is 45 by 3. 30 minus, it is not 45, it is 65 by 3. 65 by 3. So 65 by 3, 30 minus 65 by 3, so it is 90 minus 65, 25 by 3. First is difference 25 by 3. Then second, 65 by 3 minus 20, that is 65 by 3. This is 5 by 3. So the proportion of difference, here it is 25 is to 5, or we can write 5 is to 1. This is 5 is to 1 is the answer. So this is 5 times, this is 1. That is cost price of tractor. Cost price of tractor. 5 means total is 6. So 3 lakh 60 by 6 is 3 lakh. So 3 lakh by 6 is equal to 60,005. So cost of tractor was 3 lakh. And cost of carriage was, that we are proving whether it is correct or not, but answer is 5 is to 1. So cost of carriage is 60,000. So he sold tractor at a 20% profit, means sales price of tractor 20% profit, 3 lakh into 120 by 100, that is 6 by 5. So 3 lakh 60,000. Then sales price of carriage, that is 5. One is to proportion of difference cost, 5 is to 1. That means cost of tractor is 3 lakh and cost price of carriage is 60,000. So sales price of carriage, that is, it is given 60,000 and it is sold at a profit of 30%, 130 by 100. So it is 78,000. He mixed it. So total is, the total sales price is 834. So profit is 4 lakh 38,000 minus cost price 3 lakh 60,000. So it is 78,000. So percentage profit is 78,000 divided by 3 lakh 60,000 into 100. 1 2 1 2 2. Then 780 by 36. So we can write 3. 260 by 12. We can 2. 130 by 6 or 65 by 2, 65 by 3. Okay, this is the percent. Answer is average is profit is 21 2 by 3. It is also given. So we proved it also. So our answer is 5:1, means cost price total is 6, cost 6 for 6 share it is 3,60,000, for 1 share it is 60,000. So cost price of carriage is 60,000, cost price of tractor is 3 lakh. That I proved. In the tractor he made a profit of 20%, in carriage he made a profit of 30%, in total he made a profit of 65 by 3%, that is 21 2 by 3%. This we solved. Then we will discuss meaning and types of price. So mixture allegation, you can solve your problems by putting this formula. In second chapter we will discuss what are the types of costs. And we will also solve some problems. So one is mark price, or first is mark price or list price, or it is also known as catalog price. List price or catalog price. The price listed on the face of the article is known as list catalog price or list price or mark price. So this is the nominal price of which an article is quoted, tendered by a seller to invite offers from the prospective buyers. This price stands printed, typed or tendered by seller, stamped or written either in the price list of the article or on the body of the articles themselves for information of the prospect. In fixing such a price, a margin is added to the cost of the article. So cost of article plus some margin is added to cover the sales price. This mark price is cost price plus margin. Margin is added towards discount to give discount to the customer and also to earn profits. So this is the margin which is added to the cost of article, then it is given on the catalog price. It is known as list price, catalog price or mark price, and it is fixed on the face of the article for awareness of the public. In fixing such a price, a margin is added to the cost of article which would give a desired profit percent after allowing a rebate called trade discount at an attractive rate to customer. So mark price is always cost price plus or minus margin for rebated profit. So formula of mark price is equal to 100 plus profit percentage divided by 100 minus discount percentage into cost price. So here MP is the mark price, CP is cost price. We will solve one problem by putting this formula. A manufacturer makes a profit of 20% of the cost of the article. So profit is 20% on the cost of the article. After allowing a trade discount of 10%, so 100 minus 10. Find the mark price article if its manufacturing cost is 675. So cost price is, manufacturing cost is 675. You have to calculate the mark price. Here it is 120 divided by 90 into 675, then 4 3 3 means 225 into 4, it is 900 rupees. So mark price is 900 rupees. That we can prove also. Or so how we will prove it? So mark price is 900. For mark price, we will deduct the trade discount 10%. 10% 90 rupees, that is trade discount. We will deduct from the catalog price. So mark price or catalog price or list price, we will get 810 as sales price. Then profit is given 20% on cost price. Profit 20% on CP means when sales price 120, when SP 120, CP is 100. CP 100. When SP 810, CP is 100 by 120 into 810. So it is 5, 6, 810, 805 into 810 by 6. 5 into 810 by 6. So it is 3, here 405, then 3, 135 into 5. So cost price is 675. So we proved it by this way also. Either we can put the formula like this. Mark price is 100 plus profit percentage divided 100 minus discount percent cost price. This is very appropriate in competitive examination to solve the problem within a fraction of minutes. Then if it is to be proved, it is given for plus 2 commerce student, they can also, besides, suppose they could not remember this formula, simply they can remember that this trade discount is always calculated as a percentage on mark price, and from mark price trade discount deducted, we will get the sales price, then from sales price we will deduct the profit, we will get the cost price. Here in this case also we solve like this, because the cost price or manufacturing price of the article was 675. We can solve in different way also. So that is cost price is 675. So profit will add to get the sales price. Profit is how much? Various ways we can solve the problem. Profit is 20%. So 20% means 1 by 5. 135. So we'll add it. 810 is the sales price. This is the sales price. So it is 10% discount. 10% discount means we can solve like this. Because trade discount is always calculated as a percentage on mark price. What is trade discount? When the customer purchases goods of required quantity or required amount, the supplier or the seller or the trader allow him a trade discount in order to encourage the sales. So trade discount is always calculated percentage of listed price or mark price of the article. So 10% discount means when catalog price or list price, catalog price or list price is 100, this trade discount is 10. So sales price is 19. Here sales price is given 810. Here 91, we put it as 100. So when SP 90, catalog price or mark price of the article, mark price of article is 100. When it is 1, mark price is 100 by 90, that is 10 by 9. When sales price is 810, so mark price of the article is 10 by 9 into 810. That is Here this is cost price. Then added profit 20%, 1 by 5. Then total comes to 810 is the sales price. So in sales price 810, mark price is, that is 900. So mark price of the article is 900 rupees. Okay, we'll solve another problem. It is given so various ways we can solve the problem. If it is competitive exam, then we can put the formula and get the answer. Here it is given an article sold at a profit of 25%. Article sold at 25%. Then after allowing a rebate means trade discount. That is trade discount. It is given 12.5%. So we have to calculate the list price of the article or catalog price, list price or mark price of article. This we have to calculate. What is given? Profit figure is 4375. So profit is 4375. So we will put the formula, that is list price formula. List price is equal to 100 plus profit percent divided by 100 minus discount percent into CP. Then 100 plus profit is 25 and discount is 25 by 2 and cost price is because we have to find out the cost price here. So cost price of article, because profit is here article at a profit of 25%. 25% profit means when profit 25, cost price is 100. When profit 1, cost price is 100 by 25, that is 4 times. And the profit is given 4375. When profit is 4375, cost price of the article is 4375 into 4. 17,500. So we put here cost price 17,500. Then we can solve the problem by this way. There are various ways of solving one problem. This is the shortest way one can solve the problem by putting the formula. You have to remember the formula. This is 125. This is 200 minus 175 by 2 or into 2 by 170. 5 into 17,500. So it is 100. Then 250 into 100. So answer is 25,000 is the list price of the article. That we also can prove. Suppose the list price of the article is 25, rebate or trade discount, this is list price. So less trade discount. Trade discount is how much? It is given 12 half, but 25 by 2% is equal to 25,000 into 25 by 200. So it is 8. 3125. 3125 is, this is 3125. 3125 trade discount. So sales price is equal to 25,000 minus 3125. So sales price is 875, then 21,875 is the cost price. Cost price is 21,875. So sales price is this is sales price. Then profit is here 20%, 25% profit. 25% profit means when SP 125, CP 100. When SP is given 21,875, so cost price is equal to 100 by 125 into 21,875. So it is 4 by 5 into 21,875. So 4375 into 4. So the cost price will be 17,500. When cost price 17,500, sales price 21,875, then profit is 875, then this is profit is 17,500 means it is 375, then 4375. This is the given. So our answer tallies. We can solve in various ways. This is the two ways I solve the question. Then this about list price and sales price also. Discuss the price at which the trader or the seller sells the goods in the market is known as sales price, and the cost price is the purchase cost or the manufacturing cost for manufacturer. Then we will discuss invoice price. Invoice price is mark price minus trade discount plus sell tax plus invoicing charges. Invoice price. Invoice price is equal to, that is mark price minus, at this rate the bill is prepared. Suppose GST bill will be prepared, goods service tax bill, GST bill will be prepared, invoice price like this. Mark price minus true discount plus sales tax. Now it is not sales tax, it is GST, then plus invoicing charges. Some charges for invoice is given, sending the goods to reach the godown of the buyer, that is invoicing charges. So this is mark price, invoice price. So invoice price, an invoice price is one at which an article is invoiced to the doorstep of a buyer or godown of the buyer upon receipt of a specific order called indent from the customer. So on receiving indent from the customer, in the indent from the customer, the specification of goods, the quantity, quality, everything will be noted in the indent. That indent is prepared by the buyer or customer, will send to the seller or trader. Accordingly, trader will prepare one invoice price of his indent. That invoice price is mark price minus trade discount plus, previously it was sales tax, now it is GST, that is goods service tax plus invoicing charges. As a result, the goods will reach at the doorstep or godown of the buyer. This price known as shown on the body of the invoice sent along with the goods and is obtained by deducting trade discount from the mark price of the article, adding chargeable GST and delivery expenses on the goods of it. So we can solve one problem. A steel alumina is sold. Mark price of the article is 7500. dealer allows a rebate, that is trade discount or rebate, is equal to, rebate means discount on the article, trade discount or rebate, that is 10%. 10% of 7500, that is 750. And charges for invoicing, charges for invoicing rupees 343.75. Previously sales tax was there, now it is GST. GST I already discussed, goods and service tax. It may be for intrastate transaction or interstate transaction. In intrastate means the goods are within the state, means both the seller and buyer belong to same state. So here whatever GST that will be distributed in the center and state government 50-50, that is CGST and SGST. If it is interstate, then IGST, integrated goods service tax, and that is to be taken by the central government. So here it is in the question, it is given GST 7.5%. Now GST is either 5% or 18%. Suppose it is 5%. 5% means 2% will be CGST, 2.5%, another 2.5% will be SGST. We have to calculate the invoice price. So now invoice price is equal to how much? It is 7,500 minus 750. So 7,500 first is sales price. So total invoice price is the first we have to calculate how much is the sales price of the article. That is sales price. Here sales price is equal to mark price minus true discount plus GST. So here mark price is 7,500 and trade discount is 750, and that it is 6750, and GST suppose 5%. 5% means it is distributed equally. 5% it is 20, then 0. So 675 by 2. 675 by 2 means the state government will get, that is CGST will be, total is 337.50. So it will be distributed equally. CGST is this 68.75, and SGST is also 168.75. So here it is 6750 plus GST is 337.50. So this is the sales price of the article. Sales price of the article. That is, this is GST. 57,870,8750. Invoice price, we will add the charges. That is known as charges for invoicing, 343.75. 343.75. So the invoice price is this 25,7431.25. Then another we will discuss what is tender price. It is applicable for contractors. Contractors should know how to calculate the tender price of any contracts. So this is not only useful for students, but also it is also useful for common public. Though they are the businessmen, contractors, They should know it. Those who are preparing competitive, they should know it. So tender price, it is tender cost plus margin for rebates and profits. So this is also very essential for bankers, because they are the bank manager are dealing in those cases, tender or advance, they should know it. So this is a sort of mark price of an article to be produced upon receipt of a specific order which is tendered to a prospective buyer or on his request. This price is fixed by adding sufficient margin to the estimated cost which will give the desired profit percent after allowing a rebate at an attractive rate. So the cost of the article is estimated in the pro forma cost sheet in which all the elements of cost. In costing, you can see the video prepared on cost sheet. In the cost sheet, I have already discussed how the cost of a tender will be calculated. First, we will take direct material, direct labor, direct expenses. That will give us the prime cost. Prime cost. Then add factory overhead or works overhead if it is manufacturing concern. Factory overhead. It will give us work cost. Then add administrative overhead. It will give cost of production. Administrative overhead. It will give cost of production. Add selling and distribution overhead. It will give the cost of sales. Add selling and distribution overhead. That will give you cost of sales. Then your margin, add margin profit, you will get the tender price. So, cost of material, labor, service, factory overhead, office overhead, selling distribution, carefully estimated, keeping in view the past cost records and the probable rise or fall in the price and rate of various expenses. So, this is sales. Cost of goods sold. Cost of goods sold means cost of goods tender here. You see here, so tender price equal tender cost plus margin for rebates and profit. So estimated cost of material, labor plus all other expenses. Then we'll think about quotation price. What is quotation price? So all of you know, in case of tender, suppose those contractor who have fulfilled the stipulation and contractor who charge the less price for the contract will be given the tender. In e-auction, nowadays online auction is going on. All the bankers are involved in this. When account is becoming NVA and the properties are mortgaged, they are selling the property by means of e-auction. So authorized officer of all the banks, they are involved in e-auction of property, mortgage property. Then what is quotation price? By seeing the nature you can know then what is the price of the product, quotation price. So this is another sort of mark price of an article that is payable at a particular state of delivery upon orders, which is quoted to a prospective buyer on his request. In actual practice, the quotation statement furnished by a merchant contains a series of such prices payable at a respective state of delivery of goods. This price includes the following. Like this, suppose it is written loco price or X factory price. X factory price. Here, X factory price means it includes only the factory price. All other expenses will be borne by the buyer. So, when the buyer will take the goods from the factory, he has to first give the X factory price, then whatever other charges, that is transportation charges, suppose it is in the transportation, insurance, everything the buyer has to incur. So, local price includes only cost of goods at the factory or godown of the seller. That is the price payable at the locality of the supplier, which is exclusive of all expense on delivery. This is obtained by deducting trade discount from the mark price of the good. The seller normally prefer loco price. So mark price minus trade discount, this is the loco price. Generally, the business prefer this price. After that, the businessman or the buyer has to pay all the charges. Second is franco. First is loco, second is franco or rendu price. This franco price includes cost of goods plus all expenses up to buyer's warehouse. That is cost of goods plus all expenses into up to buyer's warehouse. Up to buyer's warehouse. So the price includes the price after all charges upon landing the goods are paid by the seller. This is includes all charges, including the custom duty, loading charges carried to the godown buyer. The buyer normally prefer franco price. If the buyer prefer franco price, he has nothing to do, only he will pay and he will get the goods in his door or godown. Then it is third is FS price, free alongside ship. Up to ship only the cost includes. After that, the buyer has to pay it. Free alongside ship. This is free alongside ship. This is very important for all businessmen because they should know what is written in the quotation. So the price payable at the side of the ship, which is includes all charges along with the ship, that is packing charges are included here, carriage to dock is included, dock duty is included, and dock dues and duty is also included. No, that's why it is known as FAS, free of charges alongside ship. Free of charges alongside ship. Then free on board, FOB. Free on board means the seller has taken the price including the reaching at the board or ship, board of the ship. FOB price means the cost of delivering goods to the nearest port. That is the price payable on board of the ship, which includes all charges onto the board or rail. That is free S. FAS plus charges for loading the goods on the ship. Free alongside ship plus charges for loading the goods to the ship is included. That's why it is known as FOB. Free of charges onto the board. Free of charges onto the board. Then this is free of charges onto the board. Onto the board. Then C and F, cost and freight. It includes freight also. It includes C freight charges excluding insurance. Only insurance the buyer has to pay. Excluding insurance cost is not included. Insurance cost the buyer has to pay separately. That is the price payable after the contract of affreightment is made by the seller. This is include all charges up to the contract of affreightment with the shipping company. It is the sum of FOB price, that is free of charges onto the board plus freight paid by the merchant. CF stands for cost and freight. CF means cost and freight. It excludes insurance. Then another is CIF, cost, insurance and freight. This price includes ship freight charges, include insurance to deliver the goods. That is the price payable after the contract of insurance, and freight is made by the seller. This is include all charges up to the contract of freight and insurance. CF stands for cost up to insurance and freight. Then FOR, free on railway charges. FOR, free on railway charges. This is, however, the quotation price pertaining to any state of delivery should be carefully fixed by adding sufficient margin to the cost so as to yield the desired rate of profit after allowing rebate at an attractive rate. Thus, a quotation price is obtained by QP, that is quotation price is equal to mark price minus trade discount plus all charges up to the desired state of delivery. Then market price. This is nothing but the market price of an article that rules in the market at a particular time at different figure at different level of the channel of distribution. All of you know the price is determined by the interaction of supply and demand. The place or the point where supply curve intersect the demand curve, that will determine the price. So demand curve slopes downward from left to right, indicating that more is demanded at less price and less is demanded more price, and supply curve moves upward from left to right, indicating that at more quantities, at the more price, more quantities supplied, less price, less quantity supplied. Price is determined at the point where both demand curve intersect the supply curve. That is known as also equilibrium price. So manufacturing, maybe it depends on the channel of distribution. There are various channel of distribution. First is the manufacturer. Manufacturer will sell the goods to the wholesaler. Wholesaler will sell the goods to the retailer, and retailer to the ultimate consumer. That is known as channel of distribution. Channel of distribution. So first is manufacturer. He will give the manufacturing price. Manufacturer, he will sell the goods of huge quantity to the wholesaler at huge discount. Then wholesaler keep the goods in his godown, sells goods of small quantity at more margin to the retailer. Again, retailer charges the margin amounts for profit and sell the goods in the market. So it is known as retail price. Ultimately, consumer have to bear all the expenses. Nowadays, due to e-auction facility, these are so many middlemen. Manufacturer, when directly will sell to the consumer or customer, the margin charged by the wholesaler and the retailer will be eliminated. As a result, the price will be available at the lowest price on e-marketing or e-purchase, which is now in leading position. Everyone, even a very common man, he wants to purchase by electronics. So this is consumer price. Consumer price is retail price minus retailer's discount. So we will solve one problem based on that. Solve a problem based on that. In this video, I want to complete the entire profit and loss. If any doubts, students may mark their remarks in the video so that I can help them. manufacturer price. It is given an article cost 18,000 to manufacturer. So it is cost to manufacturer. Suppose 18,000. Then if at each level of distribution profit is made 20%, discount is allowed 10%. Profit 20%, discount 10%. So we can put the formula. Cost price into cost plus profit. That is 100 plus profit percent divided by, this is the formula we can put and get the answer. Cost price into 100 plus profit percent minus 100 minus trade discount percent. Then we will get cost price here 18,000. Suppose profit is here 20%. So 100 plus 20. Suppose discount is 10%. 100 minus 10. So it is 18,000 into 120 by 90. Then this is 200, so 24,000. 24,000 is the manufacturer cost. That is the cost of manufacturer. That is manufacturing price. You can write. You can write here manufacturing price. The sales price of manufacturer, the cost price of retailer, wholesaler. Then again wholesaler cost price. That is wholesaler price. It is cost price to him is 24,000 into 100 plus profit 20 means 120 divided by 100 minus 10 trade discount means 90. So it is 0 0. Then 8,000 into 4. So it is 32,000. So first the manufacturer cost is, manufacturer price is 24,000 and the wholesaler price is, here it is given another thing, manufacturer price, wholesale price, retail price and consumer price. The percentage of load saddled to the consumer by the middleman. Profit is 20% and discount allowed is 10%. So wholesaler manufacturer price 24,000. Here, okay. So 24,000 minus 10% first. 24,000 minus 10%. 10% is discounts. So it is 10% means here 2400. That is 21,600. So 21,600 into 120 by 90. 21,600 into 120 by 90. It is determine each of the above price including load on the consumer when no discount is allowed at any level. So it is 21,600 120 by 90. It will give you 28,800. Again the retailer price. You will allow also 10% discount first. That is 28,800 minus 10%, 2880 into 120 by 90, same formula. So retailer price is now 34,560. The retailer will also give some 10% discount, that is consumer price. 10% discount means here it is 346. So minus, so we will get 0 1 1 3. 31,100. 31,100. This was how much? 34,560 it was there. 35,560 minus 3456. So it is 4 0 1 1 3 31,100 104 31,104. So total load on consumer. Here manufacturer, the cost is 18,000. Then the consumer will get at 31,104. So total load to consumer is 13,104. Total load to consumer. How much is the percentage? So load to consumer percentage is equal to, if we calculate in terms of percentage, it is 13,104 divided by 18,000 into 172.8%. When no discount is allowed, nothing, we will put the formula. That is, manufacturer price was 18,120%. So it will come to 21,600. Then wholesaler 21,600 into 120%. It will be wholesale price 25,920. Retailer 25,920 into 120%. It is 31,104. Total load will be 31,104 minus 18,000, 13,104. And percentage load is 13,104 divided by 18,100, 72.8%. Then finally we will discuss discounts. There are three types of discount. One is trade discount, another is cash discount, and third one is bill discount. That we will discuss, and we will solve also problem relating to that discounts. Here discount is three types. One is trade discount, another is cash discount, third one is bill discount. So a trade discount is a rebate from the mark or list price of an article. It is allowed by trader to his customer at the time of selling or invoicing the goods to win their patronage and attract them in large number towards the firm. It is allowed either at a single rate like 30%, suppose trade discount at 30%, that is single rate, or at a different rate in a successive manner like 15%, 10%, 5%. That is known as successive discount. This is single discount first, second is successive discount. So single discount is always beneficial to the buyer because successive discount is less because it will be charged on reduced sales price. For example, suppose this is the cost is 1,000 rupees. Suppose single discount is given. This is the suppose catalog price or list price. Catalog or list price 1,000. So on 1,000, 30% rebate one will get. 1,000 minus 30 was 70% of 1,000, that is 700. So first, if you get one single discount of 30%, sales price will be 700. And successive discount, the mark price is suppose 1,000 less first discount. First discount is calculated on 1,000. First discount, it is percentage 15%, that is 150. Then it is reduced, so 850. Second discount on 850. But many of the students, they have the idea that they will total and you see in both the way it is equal. But if 30% is the trade discount at a single lot and 15, 10, 5 in successive lot, then it is preferable to accept the single discount. So on second discount, it is suppose 10% means 85 rupees, then minus. So this is 5, 6, 7, 765. less third discount. Third discount, it is 5% divided by 20. 38.25. So the sales price of the article will be 726.75, whereas in single discount you are getting at 700. So 26.75 is the gain. If we consider it as a single discount in total, how much discount we got? So we have to calculate like this. This is first discount is 150, second discount is 85, third discount is 38.25. So it is how much? 273.25. First discount is suppose on 1000. Okay. So on 1000 the discount is 273.25%, means 100. It is 27.325%. This is successive discount. If it is discount in one lot, it is 30%. So you can calculate. in other way. Suppose there are 3 discounts, you can calculate like this. Suppose 1000 the cost price of the article, you can calculate 1000 into 85% into 90% into 95%. You get the same. This you get 726.75. Okay. Accordingly, you have to solve your problem. Then another cash discount. So a cash discount is a rebate from the amount of the debt collected from a debtor. Generally on credit sale, cash discount is allowed. Why cash discount allowed? It wants to encourage the customer to repay the debt in a quick manner or quick mode. Then also his quantum or possibility of bad debt will be reduced, and there will be liquidity of cash. Sufficient cash is available in the business. Business should not face any liquidity crunch. So a cash discount rebate from the amount of debt collected from a debtor. This is allowed at the time of collection of the debt in cash at a percentage of the debt so collected. The object of allowing such a discount are to induce the debtor for their prompt payment. Second, to reduce the size of bad and doubtful debt. Third, and produce more liquid capital for the business. However, this discount has nothing to do with any price of the article nor with the measurement of profit or loss or article. It is treated as a periodical loss of book debt. Therefore, it is deducted along with all other periodical expenses and losses from the gross profit of the period to attract at the net profit of the period. So, here such discount rate is usually indicated at bottom of an invoice. That cash discount is indicated like this. At the bottom of the invoice, cash discount is indicated at the bottom and below of the invoice like this. Suppose it is written cash 5%, means cash 5, and if you pay immediately, you will get 5% cash discount. 4 by 10, you will pay within 10 days, you will get 4% discount. 2 by 20, if you pay within 20 days, you will get 2% discount. And n by 30, under any circumstances, you have to pay within 30 days. Suppose your negotiation credit is for a period of 30 days, you are allowing cash discount to the customer, you will note as a trader or supplier, you note at the bottom of the invoice like this, this is the term cash 5, means if the customer will repay, the credit customer repay immediately, you will allow him 5% discount, that is cash discount. If he repay within 10 days, you will allow him 4% cash discount. If he repay within 20 days, you will allow him 2% cash discount. And under any circumstances, he has to pay within 30 days. This is the terms of the invoice. Or here suppose this is the question. An invoice of 10,000 made with the following terms. An invoice of rupees 10,000 is made with the term cash 5, then 4 by 10 that I discussed, 2 by 20 and by 30. Find the amount payable by the debtor and rate of interest allowed to him if he pays. Discount allowed to him if he pays. 1. Readily. Readily means he will get 5% discount. That is 10,000 into 5%. So 500 rupees he will get discount. He has to pay 9,500. Second, if he pays within 9 days. Within 9 days means, so here we can calculate the rate of interest. 500 rupees he has to pay 9,500. So rate of interest here is equal to cash discount, that is 500 into divided by 9,500 into 100 into 365 divided by 30 minus 0, because 0 is immediately paying. Answer is 64% is interest. Then second case, if you pay within 9 days, you will allow 4%, that is within 9 days. 4% means from 10,000, 4%, 400. So 10,000 minus 400, it is 9,600. 9,600. 9,600 again rate of interest will be cash discount. This is 400 into 100 into number of days is in a year 365 days divided by 9600, the amount he has to pay, into 30 minus 10, 30 minus 10, that is the term, 10 days, that is 20. So the rate of interest is 76%. Third is even if you pay within 11 days, means within 20 days. 11 days. 11 days means he will be allowed 20% discount. 20% discount means 10,000 minus 20% discount, that is 200. So he will pay 9800. So his rate of interest is calculated like this, that is the discount is 200, cash discount, into 100 into 365 divided by this is 9,800 into 30 minus how many days? It is written you have to pay within 20 days. 30 minus 20, that is 10. So answer is 74.5%. Then the last one is bill discount, that we have already discussed in bills of exchange. Again I am discussing it. This bill of discount means when the drawer, that is the holder of the bill, is in need of money, he may approach the bank for discount of bill at the bank. And this bills of exchange is covered under Negotiable Instrument Act 1881 and it is defined under section 5 of the Negotiable Instrument Act. What is bills? Bills of exchange is an instrument in writing containing an unconditional order signed by the maker directing a certain person to pay a certain sum of money or to the bearer of the instrument thereof. So while preparing the bills of exchange, the banker, suppose bill value is 10,000 and the term is suppose 4 months. Suppose 1 month, the drawer or the holder of the bill after 1 month will go reach the bank after 1 month, and suppose bank will charge 15% interest. So how much is the banker's discount? So banker's discount is here, banker's discount. Their bill value is 10,000 which the drawer will pay after 4 months. After 1 month, for 3 months, the bank will charge interest. 3 months is known as the unexpired period of the bill. So 10,000 into 3 by 12 into 5 by 15 by 100. This is the charge. That is 375 rupees banker will charge. That is known as bill discount. A bill discount is rebate from the value of bill of exchange or promissory note for the period of its early payment allowed at the bank rate either to the debtor or to a banker. As such, it is of two types, true discount and banker discount. However, this discount nothing to do with any price, profit or article of loss of an article except that it is treated as periodic cost. Again, true discount and banker discount we will also discuss in chapter bills of exchange while preparing the video. I think this video will be very helpful for all the students and those who are appearing the competitive exams, and also to bankers and the businessmen, contractor who are involved in such type of profit and loss related activities. Thank you for watching the video. Don't forget to like and share the video to all of your friends so that everybody will be benefited, and it will create an enthusiasm in my mind to create or to prepare more and more video and present before you. Subscribe if you have not already subscribed.